I wanted to ask you about the hedge fund working group that the Financial Stability Oversight Council, FSOC, formed a few years ago. Can you describe whether this working group is actually, in fact, doing any work and the nature of that work and when we can expect to see any work product? It's been a little over 2 years since we've had any information from that working group, and I would like to see its results and what it's doing.
I'll have to look into that for you. I'm sure that we have a number of staff who work full-time with the FSOC, or part-time at least with the FSOC, and I can come back to you on that. I don't personally know what that working group is doing. Okay,
so in your role as a member of FSOC, I would appreciate your following up with that working group and getting a briefing for yourself and sharing it when you can on what they're doing. As you know, no banks failed last year. The period in American history when the nation went the longest without a single bank failure was across 32 months from 2004 to 2007, just before the financial crisis. Then we had 3 banks collapse in 2007, 25 failed in 2008, 140 failed in 2009, and 157 banks failed in 2010. Since the FDIC was created in 1933, until that run-up in the financial crisis in 2004, not a single calendar year had passed without a bank failing. Do you agree that a long stretch without any bank failures can lull the public and even financial market experts and regulators such as yourself into a false sense of security?
I think really we're talking about human nature here, so yes, I do think so. I would say, though, if I may add, that the banking system is now so much better capitalized and more resilient than it was, and we've made sure to kind of allow for that aspect of human nature, I think, by making a system that's much more resilient to shocks.
So I appreciate your point about the importance of making sure the system is correctly capitalized, but is the Fed not reducing loss-absorbing capital requirements for big banks?
No, we're not.
And have you changed the capital holding requirements and the leverage ratios and the measures of the measures that are used in the stress tests, especially for banks that are under the $250 billion threshold?
I think overall we've raised capital standards. We've effectively doubled the amount of capital in the largest institutions. And
since when?
Since before the crisis.
Oh, okay, so I'm speaking about in the most recent couple of years. What has the direction been generally in terms of capital holding?
It's been to hold capital right where it is. I think the Fed's view has always been that we don't want the leverage ratio to be the binding. We want it to be a high and hard backstop. We don't want it to be binding. And it had become binding at its current level, so we lowered it a bit. The actual amount of capital that will leave the system, including the holding companies, is very, very small.
So in fact, in the most recent couple of years, we have, in your view, moderately reduced the capital holding requirements.
It's actually de minimis.
Okay, but we are going slowly, somewhat down.
No, I like to see that. I think we're holding the level where it is. The leverage requirement, it's far less than 1% of capital. It's a relatively tiny amount of capital that leaves the system. Some of it can leave the bank to go to other parts of the holding company, but it doesn't get out of the holding company. And other than that, we're absolutely holding the line on capital. It's not in our thinking that capital levels are too high.
And with regard to stress testing, which is one of the ways that we assess a risk, my understanding is that the Fed has recently advanced proposals to reduce the stress testing standards.
No, I wouldn't say that's right now.
What can you describe then for me and for the committee? What have been the changes? So, and then maybe we can characterize them differently, but I'd love to hear from you about that.
You know, we've tried to improve transparency without, I mean, the whole idea of a stress test is it should be stressful and in some sense surprising, and the scenarios change every year and that kind of thing. At the same time, we've tried to be more transparent about the way we look at losses and that kind of thing. I think the banks make the point that, you know, this is our binding capital requirement for the biggest banks, and we ought to have some transparency in terms of what it's going to be so that our own capital isn't volatile year to year. So we've tried to address those concerns, but without undermining safety and soundness and without at all limiting the bindingness of the stress tests.